Hi class, pleasant day to all of you. This is your Prof. Sir Dan, and in this video, we are going to discuss partnership dissolution. Basically, partnership dissolution is the change in ownership of the partnership business. So here we are going to discuss part 1, which are concepts, causes, and accounting considerations of partnership dissolution. Let us start. So, change in the relation of the partners ceasing to be associated in carrying on the business. That is the concept of partnership dissolution. Okay? Dissolution occurs if there is a change in ownership of the business. Take note, change in ownership of the business. On dissolution, partnership is not terminated, meaning the partnership did not close its business. Okay? Nor it does not imply that the operations of the partnership will come to an end. However, in certain situations, dissolution may cause liquidation, and liquidation, this is the termination of the partnership. That is only in certain situations. Okay, class, let us take a look of what are the causes of dissolution. First, admission of a new partner. Okay. Next, withdrawal or retirement of a partner. Third, the death of partner. And lastly, the incorporation of partnership. So these are the 4 causes of dissolution. So now class, let us discuss the accounting considerations in dissolution. Since that dissolution is change in ownership, so the changes in ownership due to dissolution will be reflected in partners' capital. The accounts to be updated are partners' capital and drawing accounts. Okay? The first consideration is asset revaluation. Asset revaluation means that there is an increase or decrease in the value of partnership assets. Okay? So let us illustrate that. First, let us illustrate the increase in the value of assets. The increase in the value of asset is based on fair market value or appraised value. The pro forma to record the increase in the value of asset is this. We will debit the corresponding asset account and credit partner's capital. So whatever the amount of the increase in asset will be distributed to the existing partner's capital. Okay? Example, if land is increased from 200,000 to 500,000. So in this example, there is an increase of 300,000. Okay? So the question is how we are going to distribute the increase to partners. We are going to base it on the profit and loss ratio. That will be the basis of distribution. So we have to make sure that we are aware or we know the profit and loss ratio. Let us also check if the profit and loss ratio is based on capital balances. Okay? So these are the things that you have to consider. Example, if profit and loss ratio is based on capital contributions, then let us take a look of the capital contributions. So in this case, if partner A has 500,000 capital contribution and partner B has 300,000, then we have to get the ratio of these capital contributions. So based on this capital, our ratio would be 62.5% for partner A, and for partner B, we will have 37.5%. How did we get this? Okay, 500,000 divided by the total contribution of 800,000, you will get 62.5%. And for B, 300,000 divided by 800,000, you will get 37.5%. Okay? So here, the increase in land is 300,000, so we will debit land 300,000, and then we are going to distribute the increase of 300,000 to partner A and to partner B based on the profit and loss ratio, which are 62.5% and 37.5%. So multiplying 300,000 by 62.5%, you will have 187,500, and 300,000 times 37.5%, you will have 112,500. So this will be your entry. Okay? Next is that the continuation of asset revaluation, which is the decrease in the value of assets. And decrease in the value of assets is called asset impairment. So the pro forma entry is that we have to debit the partner's capital because we are reducing it, and credit asset because we are decreasing the value. Example, inventory is reduced by 100,000. So in this case, we will still be using the profit and loss ratio. And from previous example, we have this, and our example has a ratio of 62.5% for partner A and 37.5% for partner B. So to distribute that, we have to reduce the capital of partner A and partner B. And with the reduction of inventory, okay, of 100,000, so 62.5% of 100,000, we will have 62,500, and for partner B, the share is 37,500. Okay, so a credit to inventory of 100,000. Okay, let us move on. Next is the second accounting consideration is the distribution of profit or loss to existing partners. Income statement has to be prepared to determine profit or loss which will be distributed to existing partners. Okay? Take note, only to existing partners. So let us distribute profit or loss to the partner's drawing accounts. The partner's drawing account is the account that we are using when we are distributing profit or loss to partners. So again, the basis of distribution is the profit and loss ratio. So the pro forma entry is this. For profit, we will debit income and expense, summary. Okay, plus take note that if the business has a profit, you will find a credit on income and expense summary. So if you want now to distribute the income and expense summary or close it, you are going to close that to the partner's drawing. Okay, and if it is a loss, then the income and expense summary has a debit balance. And if you want to close the income and expense summary, you will debit the partner's drawing. Okay? So it means that income and expense summary has a debit balance. So if you want to close it, you will close it to the partner's drawing. Okay, so let us use the same example. And if there's a profit of 80,000, then it has to be distributed by debiting income and expense summary of 80,000 and then crediting the partner A drawing and partner B drawing using the profit and loss ratio of 62.5%. You will have this distribution. Okay? And if it is a loss of 60,000, you have to debit the partner's drawing and then distribute the 60,000 based on the ratio, which is 62.5 and 37.5%, and you have this distribution of the loss of 60,000. Okay, class? Let us move on. The third accounting consideration in dissolution is close partners drawing accounts after the distribution of profit or loss. Okay, this is the next. So the balances of partners drawing accounts should be close to partners' capital. Okay, so whatever the net balance, you have to get first the net balance of the drawing account, and then the net balance should be close to partners' capital. So here in getting the net balance, we have to check if there are drawings from previous periods, okay? So all the drawings within the year or within the reporting period, we have to make sure that we have considered it, okay? Then we have to post the journal entries on the distribution of profit or loss to the partner's drawing account. And then let us, based on these two, normally in the classroom problems, we will be considering the previous period's drawings and the distribution of profit in getting the net balance of the drawing account. Then after that, we will now close the net balance of the drawing account to capital. So the pro forma entry, if the partner's drawing net balance is credit, okay, normally the partner's drawing account has a debit balance. But because of the profit that we have credited to the drawing account, it may result to a net balance of credit, okay? So in this case, what we are going to do is we will debit the drawing accounts and credit the capital account. So we are transferring the credit balance to the capital accounts of the partners, okay? And if the partner's drawing account has a net balance of debit, okay, so in closing it to the capital account, we are going to debit the capital and credit the drawing account, okay? So these are the pro forma entries in closing partners' drawing accounts. Okay, let us move on. And let us have an illustration, okay, for the three accounting considerations. We will use the previous example of PJ partnership, okay? In our example, we have this balances of accounts of PJ partnership. Okay. Here you have here on the bottom the income statement, and the upper part is your statement of financial position account. Okay. The profit and loss ratio, if we are going to base it on this existing capital structure of Pedro at 500,000 and Juan at 300,000. So the capital structure based on current capital balances will be 62.5% and 37.5%. Okay? Let us have this as our basis in our illustration. First, let us have an asset revaluation. Okay, in this we will assume that the land was revalued at 500,000. So there is an increase of 300,000. So we are going to distribute the increase of 300,000 to the capital account. So our distribution will be the 300,000 times 62.5%. Then there will be an increase of 187,500 for Pedro's capital. And for one capital, 37.5% times the 300,000 increase, there will be an increase of 112,500 to Juan's capital. So adding these increases from asset revaluation under capital accounts, we will have this journal entry. We will debit land of 300,000 and we will credit Pedro capital at 187,500 and Juan capital at 112,500. So with this entry, there will be, the land is already stated at 500,000. So there will be an increase in Pedro and Juan's capital. Okay, so this will be the additional, with the additional capital from asset revaluation, this will now be the new balance of Pedro and Juan capital. Okay, this is for asset revaluation. And now let us illustrate distribution of profit. Okay? So, in distribution of profit, we have first to prepare the income statement. So, based on the income, these are the balances of the income statement accounts. And if we are going to close expenses and revenue to the income and expense summary, this will be our entry. We will debit the income and expense summary to close the expenses and credit the corresponding expenses. Okay? So for the revenue side, we are going to credit the income and expense summary to close our service income because our service income is credit. So to close that, we have to debit it and credit income and expense summary. Okay, so all expenses are now closed and the revenue is also closed. And the balances in our income statement is only the income and expense summary at 544 debit and a credit of income and expense summary at 760,000. So we will pull this out in the T account. We will pull out the T account of income and expense summary. You will see this amounts. A debit of 544,000 and a credit of 760,000. Okay? So the net balance of these two amounts is 216,000. So meaning, because it is credit, the income and expense summary is credit, so we have a profit. Okay, we have a profit. If the income and expense summary shows a debit balance, it is a loss. Okay, so in this case, we have a profit of 216,000. So we are going to distribute this profit of 216,000 to Pedro and Juan based on the profit and loss ratio. Okay, so 62.5% is for Pedro and 37.5% is for Juan. So let us distribute this by doing an entry. So we will now debit income and expense summary because we are closing the income and expense summary to the respective drawing accounts. We are distributing to Pedro and to Juan. So we are going to credit the respective drawing accounts of Pedro and Juan. And the share, 216 times 62.5% is 135,000. And 216 times 37.5% is 81,000. Okay? And the next one is that, so now this is now an additional of 135,000 and 81,000 for Juan. Okay? So let us reflect this portion, okay, in the next slide, this capital or equity portion. Let us continue the illustration. So as I have said, we will reflect this portion. And we have done, okay, this equity account, this is the original. So let us structure the T account for this. So here you have, for Pedro, you have the 500,000. For Juan, you have the 300,000. And let us also look at the T account of the drawing. So you have the ratio here. So the T account of the drawing will be, this is a reduction of the capital. And we all know that liability and equity has a credit balances, and that the drawing account is a contra account of the capital. So since it will be a contra account, it will have a debit balance. Okay, the drawing accounts will have a debit balance. So this is how the T accounts of Pedro Capital, Juan Capital, Pedro Drawing, and Juan Drawing looks like based on this equity. And we have already made certain transactions on the asset revaluation. We have done this entry. Okay, we have debited land at 300,000, credited Pedro Capital 187,500, and Juan Capital 112,500. Plus, we are trying just to emphasize the transactions that we had from the previous slide, okay, with regards to asset revaluation. It is a continuation, okay? So here, with the asset revaluation, now we are going to pause this uh, capital distribution from asset revaluation to the respective capital accounts of Pedro and Juan. So you will have here 187,500 and 112,500. Okay? We also did the distribution of profit from the previous slide. So in the distribution of profit, we have this income and expense summary account. Okay, so we did also this journal entry for the distribution of profit. So now we are going to show in the drawing account the credit of Pedro drawing at 135,000 and Juan drawing at 81,000 from the distribution of profit. So here, Pedro drawing will have a credit of 135,000 and Juan drawing at 81,000. Okay? So, class, the next is that we will close the drawing accounts to capital accounts. Okay. So this is the third accounting considerations. The first one is asset revaluation. The second is profit distribution. And the third is closing the drawing account. So to close the drawing account, we have to know the net balance. Okay. Here, 50,000 debit and credit of 135,000. So the net balances are 85,000 for Pedro and 41,000 for Juan. So this is 135,000 minus 50,000 will give you 85,000. Okay, there is a credit balance of 85,000. Here, 81,000 minus 40,000, 41,000. So to close this, since it has a credit balance, so we have to debit that because we are closing. Closing means you have to zero it out. So we have to debit Pedro drawing at 85,000 and Juan drawing at 41,000. And these amounts, okay, will be now transferred to the capital accounts. Okay, Pedro capital 85,000 and Juan capital 41,000. So if we are going to pause this, okay, then we are zeroing out because the credit balance of Pedro, okay? And then also zeroed out the credit balance of Juan. Okay, so in this case, now this balances is no longer, is already zeroed out, okay, because of these transactions. And there will be an additional capital of Pedro at 85,000 and additional capital of Juan at 41,000. So now, if we are going to get the balance of Pedro capital and Juan capital, Pedro will have 772,500, adding all of these three credits. And Juan capital will have 453,500. So in this case, the new capital balances of Pedro and Juan will be 772,500 and 453,500. Okay? Okay, class. Let us move on. But take note, class, even that there was a change in the capital structure because you have distributed the land, the asset revaluation, and the profit with this profit and loss ratio. So you will still be maintaining the same profit and loss ratio. If you will add this 277,500 plus 453,500, whatever the total amount, then if you are going to get the profit and loss ratio based on that, you will still be getting the same profit and loss ratio. Okay, let us move on, class. And now let us take a look of how are we going to prepare the statement of partners' equity. From the previous slide, we have this capital accounts of Pedro and Juan. So the statement of partners' equity will look like this. we have to have the heading. By the way, it is best that you will prepare your statement of partners equity in Excel, and you will have the columns for your partners. You have Pedro here and Juan, and you have to have the total. The first is the capital balances beginning. Okay, the capital balances beginning will be 500,000 and 300,000, respectively, for Pedro and Juan, or a total of 800,000. Next, you have the asset revaluation, and you have additional uh, capital from asset revaluation, 187,500 for Pedro, and for Juan, 112,500, for a total of 300,000. And the next transaction that we had is the distribution of profit. Okay, so when we distribute the profit, we closed the profit to the drawing of the net balance of the drawing account, okay, to the capital account. So we distributed the profit, and at the same time, we closed the drawing account. So in doing that, we have uh, closed the drawing account at to capital at 85,000 and 41,000. Okay, take note, class, that the profit of 216,000 was reduced by the previous drawings. Okay, so that's why we only added 126,000, because this is the net balance of the drawing account. So after that, you just have to add to get the adjusted capital balances. You just have to add, and you will see that this is the amount of the adjusted capital balances. So now you have the presentation of the statement of partners' equity after considering the uh, the asset revaluation, profit distribution, and closing of the drawing account. Okay, and based on this, you can also uh, present the adjusted uh, profit and loss ratio, which is basically the same. Okay,